What if FP&A stopped just reporting sales numbers and started influencing them? In this video, I'll show you how to analyze a sales database, not like a finance person, but like a true business partner. We will look at what a typical sales CRM might look like in many companies, and more importantly, what you should be looking for to drive profitability, cash, and reduce risk. Let's take a look at the sales database. Before we dive in, a quick disclaimer. This entire database is synthetic. I built it purely for this exercise, so while it reflects real-life FP&A logic and commercial structure, it's not meant to be perfect or fully realistic. That said, it does help us understand the kind of data and insights a sales business partner might work with. So let's dig in. The purpose of a sales FP&A business partner is simple but powerful. We're not just crunching numbers, we are translating sales activity into financial insights, helping commercial teams make better deals, shape more profitable pricing, and ultimately drive smarter, faster decisions. Now, to do that, you need more than surface level CRM. You need visibility into the entire sales process, from the pipeline to pricing to margin. And that's exactly what this mock database tried to show. Let's start at the top: opportunities. In most CRMs, sales opportunities go through familiar stages: lead, qualify, proposal sent, and finally close deals and lost deals as well. That's your typical funnel. But from a revenue planning perspective, it's tempting to stop here. Just take the number of leads, apply a conversion rate, and boom, forecast revenue. But if you are in FP&A, you know it's never that simple. Our job is to go deeper, to ask what else these stages are impacting beyond the top line revenue. And that's where this database gets interesting. So let's take a look into the tabs of this database. Opportunities tab. On this first tab, we've got the opportunity log. Each row is a deal. You see opportunity ID. Let me go to the top. You see opportunity ID, you see client ID, you see creation date, and you see planned close date. You see when it's actually closed and the stage that it's in. Then, in the next tab, we zoom in the details of each opportunity. For example, let's filter one opportunity here just to check how it looks. Opportunity 0001. You see here that we sold on this opportunity, we sell two products. We sell product 10 and product 23. Okay, I am not very creative in giving names to my products, but those are the names that I came up with. So we have here the unit price that we charge it. Let me get rid of Copilot because it's annoying. We get here the unit price that we charge it. We get here the quantity that it was demanded by the client. Then we have the opportunity amount, which is simply the unit price multiplied by the quantity. Most importantly, I also merge in the cost data from the ERP. So you also see here what is the unit cost of those products. That way I can calculate the profitability. So this is where the magic happens. Product 10 was sold for $742 and it costed to me only $490. Product 23 was sold for $280 and it costed to me $330. So here we have a loss right here. But one gain compensate the other loss. So that's how sales work. They will make deals, they will make proposals that will be interesting for the client. So they'll give away some products, they will make more discount in some products in exchange for the total amount of the opportunity. Now, going on with our walkthrough, let me just clear here. I also have a tab for the clients. Again, not very creative with the name of the clients, but I have here what are the name of the sales rep, and I have also here what country they're in. So if you want to slice and dice a little bit and go into what kind of country this company is selling to, if you want to analyze that way, we have that option. And I also have here the products, which I told you before, I'm putting into a category. It's just all made up. But I'm also bringing the unit cost so we can check the profitability of those deals. Now I gotta remind you that for the unit cost, don't go too crazy about it. I know that probably in real life, your cost structure might be more complex than just this, but try to get something simpler. It's just a first step analysis, and you need to actually give a direction to sales without overwhelming them. So probably if you go with standard cost, it would be a good option because it doesn't change day to day, and it's just there the full month, and you can use that as a parameter for the sales team to work on in making the proposals more profitable. It will be directionally right the same way if you use a constant standard cost instead of just changing the cost day to day according to actuals. So try to use a standard cost, which is something that is you're probably going to have to explain the difference between standard cost and actuals later on if you are an FP&A for operations or something like that. But for now, for this type of analysis, I think it's perfectly fine to just use standard costs. Now that we have understood the data set, let's dive into some analysis. And let's start with the most obvious one, the revenue. The first thing I did was to use a Power Pivot table to analyze revenue by deal stage and some customer segments. This way I can break down how much potential value is sitting at each stage, like leads, qualified proposals, and closed deals. I flip the funnel upside down here. So at the bottom, you see the leads coming in. These are early stage and usually unqualified. Once we qualify them, we get more certainty what products the clients needs and how much they're willing to pay, of course, and when they might close the deal. Then we move into proposals. These are the real opportunities that finance should pay close attention to because they fit direct into our forecast. We might even assign a percentage of leads or qualified deals to the forecast based on historical conversion. Finally, we have closed deals. Here we have from January to July, actually mid-July in this case, but we should reconcile this closely with what's in the ERP, where actual invoices are recorded. This comparison between the CRM and the ERP is an ongoing task for FP&A, making sure the closed deals are invoiced and revenue is recognized. After revenue, the very next thing I look is profitability. More specifically, gross margin by deal. To do this, I brought in the unit cost data, as I showed you before, from the ERP, and I calculated the margin at the line item level. Then I aggregated by deal stage and segment, but you can analyze it in many other ways, by client, by product, by region, or salesperson. This analysis helps you answer a critical question. Are we writing profitable proposals? Let me show you one example that stood out. In the logistics segments, we can see here that there is one month that is a little bit under the usual, everything else is more than 50%. So this one stands out because it's one that is a little bit under the average. It's 28% in this month. So let's dig in and see how we can filter this down and understand what's going on right here. So to filter this, I'm going to filter only logistic. And then I'm going to filter the stage, and that's just to make it easier to see. This is on the proposals stage. So you can see this is the bad guy that is bringing our profitability down. So I'm going to bring more clarity to this number to see which client, which opportunity might be causing this. So I can come right here and I can bring the opportunity ID, which would be a good one, or I could bring the client if there are many opportunities with the same client. But let's just bring the opportunity ID. So I can see here that in September, we can see one opportunity that is very low gross margin. And that's what's bringing our total down. So I'm going to check this opportunity 295. I'll go to opportunity lines and I'll filter to 295. Now you can see here that I have 3 lines in this opportunity, actually 2 products. I'm repeating product 10, I'm selling on the first line, product 10 on the unit price of $8.31, but it actually costed me $490. So I have a gain right here, 31,000. But on the second line, I am selling for 200, but it costed me 319. So I already have a loss right here. Then I'm adding another line, which I am selling for 200, a product that costed me 490, which is the same as here. So I don't know if this should be a mistake or if this was something that was agreed by the salesperson to make it more interesting to the customer. There might be a reason for that. It's important to understand what are the reasons behind opportunities or proposals they are not so profitable. They might be negotiating a quick payment terms. In this case, it's not the case. They're negotiating 90 days of payment terms, but they could be negotiating a quick cash. So it could be that. They could be putting a large order on another product that is much more profitable. Then they would bring another one to make it even, just to be like a hook to catch the client with that. That could be it. There could be many possibilities for sales to be doing something like this. Of course, on a real company that is really big, you probably won't go to this level of granularity. I'm just showing as much as you can go with a database like this, but you might be able to go at least on the segment level or on the region level and understand what profitability looks like in the proposals for this group of customers. And that's something that you may be able just to act together with the commercial team to increase the profitability or improve the payment terms or reduce the risk of the company or whatever else you choose to do. So in this case, let's say I go back to the salesperson and I talk to them and they say, oh, this was a mistake. Or they say, oh, I think we should increase a little bit the price and send the proposal with a better profitability. So let's say instead of the 200, I charge them 400, which is still loss, but probably not as much. So I can refresh this right here. And let's check how it looks there. So now I increased a little bit from 5 to 19, my gross margin for this opportunity. And I increased also the full month to 34.9. So let's say I really want to increase much, much more. I don't want to make any discounts for this customer. I want to make it profitable for us. So I can come here on the opportunity lines back again, and I can put anything above the unit cost. So let's say I put 400 for this one, and I put 600 for this one. So now we have gain in all the lines. Let me refresh, and then let's check back on the profitability. Now it makes more sense. We still have a low profitable. It is profitable, but a low profitable opportunity. If I want to make it even higher, I can go on and increase even more by putting this 600 and this 900. And now when I refresh, I will see that now I have something closer to the average. I can play with this for hours, and with many types of opportunities, I can go and speak to many of the sales reps to see how we can increase the profitability, how we can improve the payment terms if it's the case for the cash. I can do that one-on-one. I can do that by segment. I can do that by region. I can do that by groups of clients. The main thing that I want to take from that is that finance is not only there to report. Finance can go back and act like a business partner. You can support sales, not just reporting problems, but collaborating to fix them before the deals close. Now, another analysis, payment terms. Now let's look at payment terms which directly impacts the cash flow. I have here the same way that I calculated the profitability, I also calculated the payment terms. So the DSO, days of sales outstanding. If it's too high, it means cash is slowly hitting the bank. That could cause liquidity issues down the line. Sales teams negotiate payment terms, so it's our job as an FP&A for sales to flag issues and guide improvement. For example, I found a proposal in August for finance that has a very high payment terms. It's calling for 84 days of payment terms. This is quite long for the average that I'm seeing all around. So to improve, I can go back and do the same way as I did with the profitability. I can go back and check what customers are getting proposals that is averaging to 84 days. Is there any possibility that we can decrease the payment terms sent on these proposals? Is there any way that we can give a better discount as an incentive for the customer to pay faster? That's something that FP&A sales could be working with the sales team to improve the days of sales outstanding before we even send the proposals. So it is possible to have an active role in improving the numbers instead of just reporting the numbers. That's a very important role for FP&A sales. Another important analysis that I just added here is the Pareto analysis, or the 80-20 rule. Many clients make up to 80% of our revenue. How many? Are we too much spread around with those clients, or we are concentrating our revenue in the hands of just a few clients? When you do this type of analysis, when you try to understand how many clients account for 80%, and that depends on the policy on your company, it can be 80, it can be 70, it can be 90. When you do this type of analysis, you are understanding the risk of your revenue. So you are analyzing how much risk you have of putting a lot of revenue in the hands of one client. Of course, you are not going to turn down sales because it accounts for a big percentage of your revenue, but you have to make sure that if you lose that one client that accounts for 10% of your revenue, you're losing 10% of your business. This is a big thing. So this type of analysis help you identify where we are overexposed by client, by segment, by region, and then push sales to diversify. We're not saying turn down, but we are saying we need to mitigate the risk. Now, this is where things get exciting. All of these insights, revenue stages, gross margin, payment terms, client concentration, they feed into a more reliable forecast. Why? Because now you're not just guessing. We are building forecasts based on what's actually happening in the sales pipeline, what products are priced at, and how clients are behaving. So when the actuals come in, when you compare them to the forecast or budget, we can explain the variances with confidence because we build the forecast that way. For example, if a margin is down in a particular month, we can go back and pinpoint the strategic deal or segment that drove it. Why? Because we build the forecast ourselves together with sales, and we know the story behind the numbers. That's the value of FP&A. That's the value of partnering with sales. You're not just analyzing, you're influencing better outcome. Keep in mind that this is just one way to analyze sales performance. Every company has a different structure, different systems, different commercial strategies. So your approach as a business partner will always depend on how the department operates. The real takeaway from this video isn't just the numbers on the dashboards, it's about a mindset. As a business partner, especially to a department like sales, your first job is to observe. Understand how the team works. What drives their decisions? What do they care about? What do they ignore? Once you understand that, then you can bring in financial insights that actually make a difference. In this example, we saw how FP&A can impact 3 key areas: profitability, helping sales, writing more profitable proposals; cash conversion, improving payment terms to bring in cash faster; and risk, identifying overdependence on certain clients or segments. But these are just a few levers. What other financial levers have you seen in your company? Drop your thoughts in the comments. I love to hear what kind of analysis you do as a business partner to sales or other departments. Stay tuned. We are going to go over all the other departments, not all, but the main ones. And there might be a few challenges coming your way, and I hope you get to participate on this.